Hi, everyone. Welcome to the second webinar of Latin American Tax Policy Forum. It is our pleasure and our honor to have some of the most prestigious panelists in Latin America joining us to talk about tax and tax policy in their countries as well as in the region. I'm going to share with you a quick presentation about the Latin American Tax Policy Forum. Just let me share it here, the screen. And I suppose you can see my screen now. I'm going to share it as a presentation. Just a minute. Like this. You should be seeing it right now. Perfect. Okay. So everyone, thank you very much for being here. Thank you very much for participating. This is the Latin American Tax Policy Forum. It was founded in 2021 as a think tank and relaunched in 2025 as a portal for the curation and production of content on tax policy in Latin America. We give visibility to local researchers as well as local panelists in tax policy, and we facilitate the exchange of ideas between academics and practitioners from different countries in Latin America. The idea is for us to have a voice and foster our own voice in tax policy debates that are becoming more and more transnational with every passing year. And the importance of having a forum dedicated to Latin American tax policy cannot be overstated. For the members of the forum, and we encourage people to become members, you can have free access to our open access posts, in which we recommend journals, courses, and events about tax policy themes. But for members only, we have our monthly reports about current topics in Latin American tax policy. I think the last one was about the Chinese treaties with Latin America, and the next one is likely going to be about the art market. So interesting themes that connect the dots between different countries in the region. And also for members, we have a curated section with curator's notes and recommendations of nearly 3,000 tax-related articles from Latin American journals. As you know, most of these articles are not read. If they're not read, they're not cited. And if they're cited, they're only cited in their own countries. That's what we hope to change. So hopefully more people having access to those articles will mean more visibility to local research and hopefully more of a voice for local policymakers in the making of our own tax policy. For the members, it's just very simple, straightforward. Individual members pay $9 per month and $96 in the annual plan, which would be equivalent to $8 per month. And institutional members, which include law firms, universities, and companies, anybody willing to support our project institutionally, one access would be $9 per month as well. One access would be 96 per year. But if you want to appear on our website as our partner, it's a minimum of 3 access credentials, and those 3 access credentials would give you access to all of our content in full. So that's it. We have 2 partners today, Unbekannte Farbe from Uruguay and Cortés del Rio from Chile, whom we thank very much for their support. And if you want to become an individual member, just go to our website, latpf.org/membership. And to become an institutional member and a partner, just email us at latpf@latpf.org. Now, today's event is about taxes on foreign exchange transactions. This is a topic of great interest in the region and great interest for companies in payment processing, banking, everything involving money transfers. This is very important for companies that are multinational entities as well. And as we've heard from the OECD on a number of occasions, and also international organizations like the IMF and the World Bank, those taxes can be very instrumental in designing and controlling for extra fiscal affairs in a country's domestic and cross-border tax policy. So without further ado, we'll start our panel today with Andrea Moya as our first panelist from Ecuador. Andrea, the floor is yours. I'll stop sharing my screen.
Hi, everyone. Well, first, thank you for the invitation to discuss this topic today. I'm from Ecuador. I'm a partner at Corral Rosales. So what I will be talking about is the foreign exchange policy in Ecuador. Give me just 1 second. Okay, so Ecuador doesn't have its own legal currency. The legal currency in Ecuador is the US dollar. Therefore, we do not have exchange regulations. But what we do have is a tax that I believe no other country has, that establishes a tax over the amount of currency transferred abroad. It was introduced in 2008. When it was created, the tax rate was 0.5%, and now we are at 5%. So it has increased over the time. What the objective was is to discourage the transfer of currency abroad and obviously increase tax revenue. But at the end, we will see as a conclusion if this has affected or not other topics. What are the elements of the tax? The taxable event, as mentioned, is the transfer of currency abroad, regardless of how it's made. So if you do it via transfer, via deposit, via check, all of those type of transactions are taxed with outflow tax. And payment of any nature, except for compensations. So if you have a compensation of a receivable account with a payable account, that type of payments are not subject to the tax. Who are the taxpayers? The individuals and entities located in Ecuador that do this transfer of currency abroad. The taxable base is the amount of currency transfer abroad, and the tax rate, as I was mentioning, currently is 5%, but you have some exemptions, as the import of fuels, the transactions made by foreign airlines authorized to operate in Ecuador, and the import of merchandise of the pharmaceutical sector. And you have a reduced tariff for the import of raw materials for productive sectors. Now, the law also establishes that certain transactions that are not regarded as that are not effectively a transfer of currency are regarded as such in 3 cases. The first one is that any payment made from abroad, this is with funds located outside of Ecuador, and whether those funds are of the entity or from third parties, are regarded as a transfer of currency abroad. So for example, if an entity has a bank account in the US and it makes a payment from that bank account to another foreign bank account, that will be regarded as a transfer of money from Ecuador to outside of Ecuador and subject to tax. The second case is in the case of exports. So if you export services or merchandise and you don't receive the payment for those transactions within the following 6 months, then it also is regarded as a transfer of currency abroad and you're subject to the tax. And the third case is when you make the import of merchandise. If you have not paid that merchandise once the merchandise is imported into Ecuador and 12 months has passed, then even if you do not make the payment, it is regarded as if you have made the transfer of currency abroad and you are also subject to the tax. Besides from those type of transactions, you have certain exemptions. You have a long list of exemptions that are more important for individuals. But for the case of entities, the 3 main cases that you have is the payment of dividends, the payment of loans, and certain cases with investment contracts. In the case of payment of dividends, all distribution or dividends are exempted from the tax, but in the case of the transfer of dividends to an entity located abroad, that it's directly or indirectly owned by an individual or entity that it's a tax resident in Ecuador and also a shareholder of the entity making the distribution, then you will lose the exemption. And in the case of foreign loans, you are able to exempt the transaction from the tax if you comply with certain circumstances. The first one is who the creditor is. If it is a financial institution, then you are not subject to the tax. But if it's not a financial institution, you have to qualify that foreign entity with the Superintendency of Banks as a specialized non-financial entity. It sounds complicated, but it's not. The only thing that you have to obtain and file within the Superintendency of Banks is a certificate of existence, of good standing of the entity, and declare that it is able to make loans. Then you have the interest rate must be lower than the reference rate established by the Central Bank of Ecuador. It is around 10-12%. And if you have any excess, the amount of the excess is subject to the tax. The term of the loan must be at least 180 days, and the funds must be allocated to the generation of taxable income. The funds have to enter into Ecuador, and that will allow you to register the loan before the Central Bank of Ecuador. And the only exclusion to this condition is that the funds are used to pay foreign trade operations with non-related parties. And the third case is investment contracts. In Ecuador, we have this regime where entities that are doing investments in Ecuador are able to enter into investment contracts with the Ecuadorian government. And one of the benefits that give you these investment contracts is the exemption of outflow tax in the import of machinery or raw materials. This tax is relatively easy to collect once through the entity that you do the transaction. So for example, if you do a wire transfer through a bank, the bank is the one obliged to withhold the tax. So it's relatively easy to collect. And if payments are made through other means, then the taxpayer has to declare and pay it. But what has been the impact of this tax in Ecuador? It has been relevant to tax revenue, but it has also increased the cost of imports, and in that case, the loss of international competitiveness. And it has been an obstacle to foreign investment since foreign investors do not understand the nature of the tax, and they see it as a payment to enter into Ecuador. So this has been a summarized analysis of the tax, and I'm open to any questions.
Thank you very much, Andrea, for this very insightful presentation, well within the time limit for your presentation in the panel. So thank you very much. I think it's something for us and other panelists to reflect on is perhaps the specificity of the Ecuadorian tax in terms of it being outbound only instead of inbound and outbound. Like, for example, later on, we're going to hear from Guilherme, and he is going to talk about the tax on foreign exchange transactions in Brazil, which goes both ways. But in the case of Ecuador, it's just outbound. And also, and Guilherme probably picked up on this already, the difference between the actual foreign exchange transaction, and in the case of Ecuador, just the outbound transfer of funds, because the Ecuadorian currency is also the US dollar. Because, for example, in the case of Brazil, if you use an account in the US to make a transfer to someone in Europe, you didn't have any foreign exchange transaction in Brazil, and therefore you would not be required to pay a foreign exchange transaction tax in the country. But in the case of Ecuador, that is a case in which you would have to pay impuesto a la salida de divisas. So differences that, you know, we're getting to figure out some of the similarities and differences between the taxes in the region. Now let's move on to the next presenter of our panel, Luis Mario Salazar, who is going to talk about a different kind of tax. And I decided to include this tax in the panel because it's different from perhaps what you would expect of a panel about foreign exchange transactions. But I want Luis Mario to take the floor and explain to us a little bit more about it. Luis Mario, the floor is yours.
Thank you, Lucas. Let me try to project. Screen. Yes, as Lucas mentioned, the Foreign Agents Law is a recent law that was approved in El Salvador. This is a response to certain sectors of El Salvador requiring international organizations, NGOs, to also be liable to pay taxes in El Salvador. So in that being said, the objective of the law is to regulate activities that are financed by foreign entities or foreign players. This also is being projected as a way to promote transparency and safeguard sovereignty within El Salvador, and impose obligations to those entities that are funded by outside NGOs, outside institutions, think tanks, etc. So it applies to NGOs, associations, trusts, and individuals that are funded. Any person that is directly or indirectly funded by a foreign principal, which brings us to the first point or first definition is what is a foreign principal or a foreign agent. And a foreign principal is any person that funds any activity in El Salvador, and its agent is any person that is funded by that foreign principal. The foreign principal has a connotation that it represents a government interest, a political agenda. So this is a very sectored law and very sectored tax. The tax regime is 30% of any inbound funds, with those in charge of practicing that 30% withholding tax are financial institutions and also those payment platforms, but that are subject to regulation in El Salvador that pay local agents. Domestic donations are also subject to those 30% if received by these foreign agents. So you do have this duality of inbound and an internal flow of funds that are also taxed to those entities that are deemed as agents in El Salvador. This is done under the supervision of the financial regulator, which is called in Spanish, es Financiero, and of course the tax authorities.
Luis, just one thing. I don't know if you want to show any slides. We're not seeing any slides, okay?
Oh, my apologies. My apologies.
No worries. I mean, it's just if you wanted to show slides, we're not seeing any slides.
I was sharing. Let me.
It's always a pleasure to hear you, and we can see you talking. No worries at all. But it's just if you wanted to show slides. Yeah. Now we can see.
Am I showing my screen, my slides?
Yeah, we're seeing the screen. It's not in presentation mode, but we can see the screen.
Okay,
yes.
Okay, great. Sorry, my apologies.
No worries.
Okay, so we're good, right?
We're good. Please keep going.
So one of the very important aspects of this is the RAEX, which is the Registry of External Agents, which is a registry that is required for those NGOs and or institutions that receive funds from abroad and are deemed as an external agent by the law. That does not waiver that 30% tax. However, it does prevent you to being sanctioned in other way, including the cancellation of such entity. What are in practice? What are the kind of institutions that have been affected by this law. This will include newspapers that are funded by think tanks abroad, maybe political parties that are funded by other political parties abroad, also think tanks, local think tanks, NGOs, etc. These are the kinds of institutions that may be affected by this tax, because it prohibits to operate without the registration to the foreign agents within the foreign agents registry. You cannot use funds to fund outbound funds to use for political activities or any activity that may enable any security risk for the state. It attempts to diminish any anonymous donations and concealing any foreign source of financing. Sanctions are between fines between $100,000 and $250,000. The suspension or cancellation of the entity, as well as administrative and criminal liabilities. So as Lucas has mentioned, this is a particular way of seeing this type of regulation. Is this a currency tax? No, this should not be deemed as a currency tax. Operational, it bites at the border of inflow, right? So the impact can mirror taxing on income and liquidity for those that are deemed as foreign agents. Also applies to donations, imports, or in-kind donations, right? So there are some unclear legal issues here. The relation, seems to be an overlap between commercial and non-commercial investment. The law does not define, but there has been some guidances issued by certain entities that have said that if you are a company, you should not be subject to this law. As an international subsidiary or subsidiary of an international group, you should not be subject to this law unless you practice some of the sanctioned activities. So it's the definition of political activity is also broad, and the definition of remittances also has a very broad interpretation, and it's not entirely harmonized with tax laws in El Salvador. So in summary, this law combines transparency rules and fiscal measures. It effectively is a tax on the capital and liquidity inflows, as well as some local transactions that may affect NGOs or international corporations or certain type of philanthropy. So one of the important aspects of this law is this will change the KYC scenario for financial institutions, for banks, also for those entities that are payment platforms. They probably should update their KYC procedures or KYC documentations, as they might be required by the regulator or the tax authorities to provide information that they are paying they're not paying to any foreign agent, right? This has clear political connotations. It's a way to control or to monitor who is funding who in El Salvador, and it does serve as a certain barrier to the entrance of funds, especially if you are one of those beneficiary NGOs or beneficiary think tanks within the country. So that has created some think tanks or some NGOs to think about staying in the country or leaving the country, right? So that will be in general what the law is about.
Excellent, Luis. Thank you very much for your insightful presentation. This is different from other kinds of taxes that we will discuss today. If nothing else, because of the rate, we're talking about a 30% tax in
And
comparison
it's the
to
same rate as the income tax here in El Salvador. So it's basically
exactly. So it's
it's the extension of
basically
the income tax.
yeah. So it's basically an income tax in disguise. The idea is to, or at least the justification given is that if companies locally pay a 30% income tax, those entities that receive money from abroad should also have to pay the same 30%. So it's not a tax on foreign exchange transactions so much, but it is a tax on the foreign entry or the foreign inflow of funds. And in that sense, it kind of fits into the theme of this webinar. Also, something else that is perhaps food for thought for us to think about it here and after this webinar is that policy-wise, if you want to achieve a certain goal in terms of fiscal policy and earning certain tax revenues, you have many tools available to you. You have many tools available on your belt to do so. You can raise VAT, you can raise income tax, you can create a new tax, you can tax a specific kind of transaction. So those different kinds of taxes may arrive at the same objective by different means. So instead, for example, this could very easily have been labeled as a tax on the entry of funds into El Salvador, but it is labeled as a tax on foreign donations and specifically from certain entities and entering into El Salvador. Very, very interesting stuff. So now we're going to give the mic to Catalina, who will be speaking about Colombia. And the floor is yours, Catalina.
Good afternoon. Thank you for the invitation to participate in this webinar. Today I will talk about the gravamen a los movimientos financieros, or GMF, also known colloquially as 4 times 1,000. This is 4 pesos for every 1,000 pesos. This is a tax applied to financial transactions in Colombia. And while it may seem small at first glance, it has very significant consequences. To give some background on the GMF, it was initially brought in as a temporary fix to deal a banking crisis in 1998, but quickly became a permanent tax that a major chunk of the national budget depends on. We have a saying in Colombia that there is no more permanent tax than a temporary tax. Corporations, organizations, and investors are not in favor of this tax because all it does is move money and keep track of their transactions. There is no reason behind it, like there is for consumer tax, income tax, real estate tax, among others. However, the government finds it reliable because it is a weekly source of revenue. And even in the case of tax withholding, it is tax withholding is a monthly source of revenue. GMF is weekly. Although there have been precedents that have planned to repeal this tax, it is constantly defying the pushback because it is simply too beneficial for the government. Therefore, there are not many litigation points against this tax. Firstly, because the government reaps its benefits in great amounts. And secondly, because legal entities and individuals do not have the right to appeal to get their money back from the DIAN, the tax authority, since they have to litigate against their bank. That is the one that pays it directly to the tax authority. In other words, the tax goes to a third party, which is the DIAN, and it is not accessible for people to litigate against the GMF. So what exactly is the GMF? It's a 0.4% that is applied to almost all financial movements for every $1,000 that move through an account. The government takes $4. Now, in pesos doesn't sound like much, but think about what happens when you're dealing with large sums of money or with accounts that have constant activity. Let's say you want to move $1 million US through the Colombian financial system. If you assume an exchange rate of about 4,000 pesos to the dollar, that gives us roughly 4 billion pesos. Now the GMF is charged at 4 pesos for every 1,000 pesos moved. That works out 0.4% of the transaction. So on 4 billion pesos, the tax comes to 16 million pesos. If we convert that back into dollars at the same exchange rate, that's about $4,000 in tax just for moving money. And one more important point, this tax is only deductible in a 50% from income tax basis. Therefore, at a rate of 35%, only 17.5% of the tax can be recovered through income tax. Now, how does the law actually define this tax? According to Section 871 of the Colombian Tax Code, the GMF is triggered by a wide range of financial transactions. It applies when resources are withdrawn from checking accounts, saving accounts, and official government entities. It also covers the issuance of cashier's checks, but the scope doesn't stop there. The law extends the GMF to things like transfers of rights over investment portfolios, transactions made through collection agreements, debits from non-traditional accounts, and even operations involving credit disbursement, derivatives, or foreign exchange if they ultimately result in payments to third parties. As we can see, Article 871 casts a very wide net. It ensures that almost any movement of money can potentially be taxed under this mechanism. The law also recognizes some exemptions to some transactions that are exempted from tax. That's Article 879 of the Colombian Tax Code. The list of exemption is really long, but I'll mention some, for instance. Small savers are protected. Withdrawals made from a designated saving account, an electronic deposit, or even a prepaid card are exempted up to a monthly limit of 350 UVT, that it's like $4,000 approximately, but only if the person declares that account as their sole exempt account. The last tax reform wanted to change this, and before this law, users could designate a single bank account only for 350 tax value units. But in 2024, this amount, they wanted to propose exemption for several bank accounts. However, in practice, this couldn't be done, and we have an exemption written in the law that cannot be applied. There are other exemptions, such as certain transfers between accounts held by the same bank, which means that if you move money from your checking account to your savings account in the same bank, you don't have to pay GMF. Pensioners also receive a relief on their bank account only for pension. And even transactions carried out by the official state bodies like credit disbursements and operations between supervised financial entities or with the government treasury. Now, while the tax does bring in revenue, it also creates some challenges, which brings us to the legal debate surrounding the GMF. One of the main criticisms is that this tax violates the principle of the ability to pay. In tax theory, this principle says that taxes should reflect a taxpayer's capacity to handle the financial load, but the GMF is a flat rate. It doesn't look at a person's income or a company's overall financial situation. Think of a small business with thin profit margins, but constant financial transactions. For them, this tax eats into their already limited resources. Now compare that to a big corporation with fewer, larger transactions. the tax might still cost them money, but proportionally, it affects them far less. So the problem isn't just the amount of money being paid, it's the relative burden it places on different taxpayers. Another legal idea that the GMF has bumped up against is taxpayers' equality, which signifies that taxpayers in similar spots should be treated the same under the law, which allows very limited justifications of any sort in order for an entity, whether it be an individual or an organization, to be treated differently in terms of the percentage that is taken of the value of the transaction. At the same time, we can't ignore why the GMF exists. For the government, it is a reliable way to collect revenue. This rate is small, the mechanism is straightforward, and compliance is almost automatic because banks collect it directly. That simplicity is one of its strengths, but as we've seen, simplicity doesn't always mean fairness. Through Article 871, the law makes sure that almost any movement of resources can be taxed. Through Article 879, it tries to provide some relief by exempting specific cases like small savers, pensioners, and intrabank transfers, but the tax remains controversial because it places a disproportionate burden on smaller businesses and individuals with high transaction volumes, while sparing larger players who can absorb it more easily. In the end, the debate over the GMF is not just about money. It's about fairness, economic behavior, and the kind of tax system Colombia wants to have. And that's why it continues to be such a hot topic in discussions of fiscal policy in Colombia.
Thank you, Catalina. I wasn't sure if you had concluded your presentation, but thank you very much for this insightful talk about the gravamen a los movimientos financieros. We had in Brazil, you spoke earlier about temporary taxes being permanent. We had in Brazil a tax very similar to that lasted 10 years, and it had provisional on its name. It was the provisional contribution on financial transactions. That was the translation would be that to English, Contribuição Provisória sobre Movimentações Financeiras. And that CPMF was repealed, I think, over like 18 years ago. It was 2007. And at that time, it caused enough of a problem for taxpayers and the electorate that it eventually got repealed. It was also seen as a bad tax in the sense that it stimulated people to operate with paper money outside of the financial system. So instead of using traditional bank accounts and wire transactions, they would use paper money or other kinds of in-kind transactions just to avoid paying the tax. And that was one of the reasons why, policy-wise, it was repealed. Brazil has attempted to bring it back a few times, maybe numerous times, and every time they tried it under different names with the idea of trying to sell it to the public as a good tax. I remember one of those names was the Interfederative Contribution for Health, because the idea was to use this money to fund public health services. And the genius behind this name said, well, we're going to promote it as a tax for public health. Who is going to oppose a tax for public health? And that didn't work. But the basic idea of that tax was to just basically get people to use the traditional bank channels, and that did not work as intended. Every time that policy discussions are entered into in Brazil with the idea of bringing that tax back, this comes back to remind people of that very real danger, especially, and this is something that is a transversal theme across all of the presentations in this panel. Today, we live in a world in which a lot of transactions are carried out in the crypto space. By using cryptocurrency, whether it is in the form of Bitcoin or Ethereum or stable coins. And these are other forms of exchanging money that may or may not be visible to local authorities. I would imagine that El Salvador has some control over that because of its past experiences with Bitcoin, but many countries may not have that kind of visibility. And because of that, they might not be able to track those payments. And maybe that could be an avenue for taxpayers to avoid paying taxes on the movement of money. But now to finalize the panel, we have a presentation from Guilherme Froner. He's going to speak to us about the Brazilian tax on foreign exchange transactions, IOF FX or IOF Câmbio. Guilherme, the floor is yours.
Okay. First of all, I would like to thank you for the invitation, and let me share my presentation. Just a minute. Can you see my?
I can see the screen. We're just, yeah, we can see the screen. Now we see the division in 3. We don't see the full screen with the presentation.
It's not the full. Okay, let me.
Yeah, it's just, it's divided in 3.
I think I have to switch the. Just a minute.
No worries.
Not the
While
best.
Guilherme changes the presentation. Yeah, no worries, Guilherme. The first time, Catalina, that I worked with GMF in Colombia, I remember that someone said to me, it's 4 per 1,000, 4 per 1,000. And I thought to myself, why don't they just say 0.4%? It's just 0.4%. It's just, let's work on percentages. And then people said, no, it's 0.4%. So thank you.
It's easier in Spanish. 4 por mil. It's like just a multiplication.
Yeah, no, it's and then but I got it. So it's but it was I remember that, and this is also something that is sort of transversal across all presentations. Some of these taxes are being phased out. Like they used to be charged at a higher amount, and then they kept being reduced. But it's kind of in Colombia, as you said, it's not really being phased out because it's important for the government and it's easy to collect, right?
Right. And they try to limit
Yeah.
it, like the paper money, they try to limit it in deductibility of income tax basis. So they try to avoid the problem in other ways of paper money.
Yeah, no doubt. Guilherme, we can see the full screen of your computer. We don't see the full screen of the presentation. You can present it like that if you wish, but we're just letting you know.
It's not the full screen?
No, it's we're seeing the PowerPoint and Microsoft PowerPoint screen with the slides appearing on the side, and then the slides. You can click on that button to show the presentation. But if you feel free if you want to present it like
this
that.
one here, Lucas. This one here.
Where is your cursor? I can't see your cursor.
I think that it. Sorry.
But if you want to, that would be okay if you want to present it like that. It's yeah, this is the one.
Okay,
if you
so
click on that one, it should present the whole thing. But yeah, feel free, no worries.
Okay. So the first the first slide showing the general aspects of the IOF, right?
Yes, index. Yes.
So let me start here. I'm going to talk about the IOF, the Imposto sobre Operações Financeiras here in Brazil. That is a tax that is levied upon 5 types of different financial transactions. So we have this tax is levied on credit operations, loans, insurance, securities, gold, when not the gold as a mineral, but as a financial asset, and on foreign exchange operations. Here in Brazil, the exchange operations, they always have been regulated by the government. Our capital flows, they have always been controlled by the government. But in 2021, we had a new law, and the new exchange law, it has enacted more flexible rules, and then in order for us to enter the OCDE, and our foreign exchange market, it's not how can I say, it's not so rigid and controlled by the government. So the parties, they are free to settle their contracts and buy or sell different currencies. But in order for you to carry out exchange operation, you have to count with a financial institution, like the other panelists just explained it to us, and now we have the processing companies since 2023. Now they are also authorized. They are allowed by our legislation to make the foreign exchange operations. So if you want to import a service, import a good, or if you want to export a service, for example, you are free to go to our financial institution and conclude a foreign exchange contract. So our rule here in Brazil, we have
just one thing, Guilherme, the slide that is appearing for us is the second slide still. It hasn't changed.
It hasn't changed. So, and now?
It hasn't changed. It's still slide 2.
I don't know what's happening, Lucas.
No, it's fine. If you want to perhaps not present and then have the presentation just for you, we can send the presentation to the... Yeah, now we can see slide 8.
The slide 8, but
yeah.
not in the full mode, right?
No.
Can you...
That's fine.
Okay?
Yeah.
I'll do like that, and then...
Okay, sure.
So here in Brazil, when we are studying a tax rule, usually in our doctrine, we have different elements, so we have to consider. I think that also Andrea did the same. In our case, now that the triggering event of the IOF is when you deliver or a foreign currency, or it's imported. Our legislation, it says, or a document representing it. I will explain it a little bit later. But if you want to make an inbound or outbound operation, you have to have an exchange contract, and then the triggering event will occur. Then it goes from all operations carried out through Brazil's territory. So since the operation is carried out here, you have the triggering event. The exact moment of the taxable event is usually the settlement date of the foreign exchange operation. The taxpayer is usually the purchaser or the seller of a foreign currency, and the tax authority is our federal government, and usually the one responsible for collecting the IOF is a financial institution. And now it also happens with the processing payment companies. Regarding the quantitative aspect, the calculation basis is equivalent to the amount of the national or foreign currency that is transactional, and the tax rate, and then it's part. We have a general rule of 25%. It's really high, but but it's only in the next. It's very rare that this rate is applied. Usually, our rate nowadays it's fixed between 0 up to 3.5%, but it depends on the kind of transaction that it's carried out. Here, it's like a spreadsheet containing different rates, and it's important to mention that during this year we have some decrees have been enacted by the federal government trying to raise the rates of the IOF for fiscal purpose. Now, our government is spending a lot of money here in Brazil, so in order to increase the tax, the fiscal aspect of Brazil, so it has raised a lot of the rates. And so, for example, usually we use it to pay for a remittance abroad like 1.1%, and now we have to pay like 3.5%. And a lot of international transactions with international cards, credit and debit cards, and things like that, the rates also have been raised. But before I pass to another slide, I would like just to talk about specific operations. For example, exports of goods and services, the rate is 0. When you import goods like machinery, for example, the operations, they are exempted. But when you have to pay, for example, for consultancy services, royalties and things like that, the rate is quite high. Nowadays, it's 3.5%. But it depends on, in those rates, it depends on the kind of operation. If we have loans from abroad, for example, if it depends on the average term of the loan, or if you have for a short period of time, you have a rate of 3.5 usually, but if it's above, it's like a long period loan, the rate will be 0%. But here is just an example. For example, if you want to purchase like $1,000 within the exchange rate of 5.3, you have IOFX around in dollars, in $35, in reais would be 185 reais. So it depends on it depends on the operation to see the rate. But as Lucas was saying before, when we had the tax, the social contribution, the CPMF, the rates were like 0.38%, and now it's 3.5. So it's really high for a Brazilian previous experience. And so regarding this increase, it went to our Supreme Court recently, and our Supreme Court just settled that it's allowed for the government to raise the tax. And now we are dealing with this recent increase. It's different from previous decrees that I think that in another government, for when we had Fernando Henrique Cardoso, Bolsonaro, they also have enacted decrees raising the tax rate, but it was not the background around it. The government always tried to go to a regulatory purpose for the increase of the tax rate, but this time the government just said it in TV and in articles that it was necessary to raise the tax rate to raise the amount of the tax that needed to be collected. But our Supreme Court just said that it's regular, that it's okay to do that. And now we are dealing with this huge increase of the IOF. Considering my time, I will finish, okay, Lucas, but with the last slide, because you were talking about the presumed operations, né, that we don't have here in Brazil. And your example was if I had a US account, then made a transfer to an European account. But here in Brazil, we have to maybe be careful, because we have some precedents here that the tax authorities they charge the IOF when the taxpayer tried to avoid our regulatory controls, our central bank controls. And it's a famous case regarding an operation that were carried out with a Uruguayan bank that bought T-bills from the US, and then the T-bills were sold here in Brazil, and without our regulatory controls. Now, our central bank the operation was not open, was not presented before the central bank, and then the tax authorities they charged the IOF with the tax rate of 25% plus a fine, depending on the case, but it was, I think that we have the fines here in Brazil, they are always charged about 75% plus interest. And so the tax authorities they explained that it doesn't need to have the foreign contract, but if you have a document representing an exchange operation, the IOF should be levied. So it was the same case with the T-bills. And so and I think so all my time. Okay, thank you everyone, and I think that's are my considerations regarding the IOF.
Thank you very much, Guilherme, for your presentation. This is perhaps a more traditional kind of tax on foreign exchange transactions. And just to explain to the other panelists, as well as the people watching on YouTube now or later, because the video is going to be available on our website, the case in Brazil referred to the purpose of the IOF FX, or the IOF in general, which is said in our constitution, or at least not in the constitution, but the current understanding of IOF is that it is an extra fiscal kind of tax. So you use the tax to achieve extra fiscal objectives. And the government said publicly that it needed more revenue for general expenses. And because of that, it needed to increase the rates of certain taxes, one of them the IOFs, whether it is in the IOF credit or IOF FX, but they needed to increase those rates. And that was the big discussion that we had in Brazil, and that led this case to be settled before the Supreme Court, in what was perhaps one of the first instances in which we saw something like that, in which the court did not actually issue a ruling. The court basically got the Congress and the executive together and said, look, we can decide this, but it's not going to be good for anybody. So instead of that, let's find an agreement that works for both. And then they found that agreement, and the court basically issued its seal of approval on the agreement. But that was the point. It was more to do with the purpose of the IOF as a tax. And I think that my own question really to other panelists is, I know that in Colombia, and we just spoke about this, the tax was being phased out, but it is hard to remove that kind of tax from the system because of its ease of collection, as well as its kind of controlling features in terms of exchange of money that's important for tax authorities to maintain their eyes on what's happening in the market. I wanted to ask Andrea that you said in your presentation that the ISD was raised from 0.5% to 5%. Was during the time that those raises took place, at any point did the government say we're increasing the rate because we need more money?
Yes, it was
Okay.
clearly understood that it was the government needed funds. And it's, as mentioned, it's an easy tax to collect, right? You do not have to go into the profits, the deductible expenses, and so on as a corporate tax. It's an easy tax to collect. So for the government to increase the rate was clearly to increase funds.
Excellent. And for any of the three panelists, just perhaps a doubt that might emerge for people that are attending the webinar or that watch the YouTube transmission now or later. Was there any manifestation from local tax authorities or the government or judges, perhaps a case, about the interplay between the local taxes and the crypto system? For example, perhaps a tax audit against a company that used the crypto market to dodge the tax. Has that happened in any of the countries represented here to date? I take that the answer is no. I take that the answer is no because the silence. Yes, Andrea.
What has happened in Ecuador, as you can imagine, individuals have tried everything to avoid this tax. And what has happened is that several investment advisors have provided services to individuals that they pay the investment advisor in Ecuador, and the advisors locate the funds abroad for investment. But also it falls in one of the assumptions of making a payment abroad. So it hasn't flagged as the advisor has expected, but that has been one of the things that has been tried.
And perhaps one question for Catalina, which might be relevant for Guilherme and for myself as well, considering Brazil's attempt to become an OECD member, which is something that varies from government to government. I would say that the current government is not particularly interested in becoming a member of the OECD, but that changes sometimes. You know, if it's kind of a right wing or center right government, that can change. But the question to Catalina is, Colombia is a member of the OECD, and Colombia has a tax on the movement of money. My question to you, Catalina, is have you noticed or received any kind of pushback from the OECD saying, well, look, this tax is bad for imports or bad for the free flow of money? Has the OECD criticized that tax in any report that you know of to date?
I don't know, but I would like to refer to the previous question about crypto.
Yeah.
And I think this is like a more difficult thing since crypto is not like legal money from Colombian perspective. So any payment in crypto, it would be seen like a swap, like two individual operations. And that individual operation has effects in income tax. Also has effects in the difference in the tax exchange rate and the money exchange rate from the dollar to the pesos and from the amount when that crypto was bought. And also on the reports before the tax authority of that crypto, if it has been included in the tax return over all the assets.
Correct.
So the implications are far more than just paying with crypto.
Mm-hmm. Definitely. It's more than just using crypto to dodge the GMF, because if you don't declare that you have crypto, you're already incurring penalties in other areas of tax or administrative law or local laws, because you're not giving the local authorities visibility about your crypto holdings.
Yes, like that crypto holding, like if you're not including it in the income tax return, can be subject even to 200% of that crypto you're holding. So
Yeah.
the implications are far more than 0.4%.
No, definitely. I mean, and it doesn't really make a lot of sense. I mean, why would you incur a risk of, having to pay a 200% fine just to avoid a 0.4% sort of gravamen a los movimientos financieros? But the point is that I would imagine, and I would like to hear from Guilherme about this, you might have clients that just basically want to take the risk in the sense that they say, well, I don't want to reveal to the local authorities that I have crypto holdings, because the moment I do so, that's it. They know that I have them, and they'll be able to track them, or at least ask me what happened to the 100 Bitcoin that you had last year. You have to say to me, well, basically, I transferred it, I converted it into another currency, I did something with it. So the first moment they reveal it, that's it. That information is in the system. And they might just basically say, well, I don't see it as a 200 versus 0.4% risk, because I don't ever think that I'm going to be caught, which I think is just very few clients, and we don't usually deal with those clients on a day-to-day basis. But I would like to just hear from Guilherme. Have you heard, because Guilherme is like, between me and Guilherme, I'm more the international guy. I'm always talking about Pillar 2 and so on and so on. Guilherme is the financial markets guy. He knows everything about financial markets and all kinds of transactions involving funds and operations with investment funds and investment vehicles in Brazil. And I would like to hear from him. Have you heard in the market, especially considering the recent changes of the rate of IOF FX in Brazil, the upward changes, the increase, have you heard in the market people kind of moving around the crypto space to try and find avenues to avoid that tax?
Yes, actually, yes, I've heard, because there is like a new product where some companies, they are using stable coins to make the acquisition or selling different currencies and dodging the increase of the IOF. And actually, they have a legal argument that we have a specific law here in Brazil that deals with virtual assets, and according to this law, exchange operations regarding virtual assets, crypto holdings, and have to be regulated by our central bank or our authorities, and yet it didn't happen here. So it's like you have a space here in Brazil for you to judge this increase. But I would like to highlight that we have those precedents that our tax authorities, they charge the IOF in the full rate of 25% when you have a document representing a foreign exchange operation. And that's the case of the T-bills that I just told you, but we have a few ones. We had a huge operation here in Brazil that was famous on a worldwide basis. That was about the car wash operation, and then our federal revenue charged the individuals that were making these illegal transfers. And so we always highlight the risk, but I know for sure that there are companies that they have specific products to make exchange operations outside the official way.
Very, very good. And I've certainly heard a lot about crypto in recent months, also as a response to the increase in the IOF FX rates in Brazil. And at the end of the day, if you have to pay a 25% extra tax on the foreign exchange of funds, it goes back to Andrea's point. It's just an added cost to the transaction. It's an added cost to imports or investment or a loan if you're not qualified, even though you have exceptions for loans in Ecuador. So it's something to think about if you want to operate a business that has any kind of cross-border transaction load in the region. But thank you very much, everyone. Unfortunately, we lost Luis Mario, who had a power outage. He said that he would come back, but no worries. Thank you very much for your insightful presentations. The panelists that spoke here today are contacts of mine, and I thought it would be great to get them all together to speak about a very different kind of theme. We don't usually hear presentations about foreign exchange transactions, kind of a very subset of taxes that people don't talk a lot about. And I thought that it was a good opportunity to get people together to discuss this topic. So thank you very much. Have a great rest of your day, and we'll keep in touch. Thank you.
Thank you.
Thank you,
Bye-bye.
everyone.
Bye-bye.
Thank you. Bye.